I would like to give a special thanks to our LaPorte CARES task force, who helped create this presentation, research, and posted much of the information to our website. Bruce Prendergast, Jody Arsenault, Micah Stewart, Cherish Van Mullen, Connor Brown, Eric Bosch, Cheryl Haspel, Michelle Buckingham, and Leslie Paul. First, let me introduce our presenters for the day. I am Chav Pierce, Director of Tax Services for LaPorte. With me today is Bruce Prendergast, a director in our tax department who has extensive experience in all aspects of individual, corporation, S corporations, and partnership, tax compliance and planning. Bruce also has vast experience in tax issues relating to nonprofit entities and has been with the firm for over 37 years. Micah Stewart, also a tax director who received his Master's of Laws in taxation from the Levin College of Law, University of Florida, and his JD from Loyola in New Orleans, is with us today as well. Micah has an extensive background in international tax planning and regularly assists with reorganization, merger and acquisition tax issues. Cheryl Haspel is an audit director who began her professional career in 1986 and primarily serves oil and gas and oil field service companies. Her decades of experience gives Cheryl an informed perspective on the operations of her clients. Connor Brown, a senior manager in LaPorte's tax department, is with us today. Connor provides tax compliance and planning services to a variety of clients with a focus on small business advising, closely held business succession planning, and individual tax planning for the shareholders and owners of the businesses he advises. He has over 20 years of diverse public accounting experience. Also joining us today is Steve Crispino, Executive Vice President of South Louisiana Bank, a 40-year-old $500 million bank in Houma, Louisiana. His duties include oversights of marketing, human resources, branches, and correspondent services. Steve has served on the board of the Louisiana Association of Business and Industry as a past chairman of United Way for South Louisiana. Now on with the presentation. I, along with Steve Crispino, will be leading the presentation of the small business interruption loans. Bruce Prendergast will take us through the business tax provisions, and Connor Brown will review the individual provisions in the CARES Act. What are our objectives today? We are hopeful that you will have a good understanding of the CARES Act, including the loan options and how to take advantage of the tax provisions. Our intent is to inform you of certain SBA loans, business tax provisions, such as the change in the NOL rules and qualified improvement property, which could be a windfall for certain real estate. And then we go through the individual provisions, which include stimulus checks and the changes to retirement plan rules. Next slide, please. The CARES Act is the most expensive legislation ever passed. The major funding areas of the CARES Act is approximately $300 billion of cash payments to individuals. Those are the stimulus checks. $260 billion of extra unemployment payments. $350 billion for the SBA's Paycheck Protection Program. $500 billion in loans and other money for big corporations such as airlines. $180 billion for hospitals, community health centers, veterans health care, medicine and supplies, child nutrition and food programs. And then another $340 billion to state and local governments, most specific to the COVID-19 response that they have in their states. Next slide, please. So let's start with the small business interruption loans, where there are some knowns and some unknowns for which we're still awaiting guidance. There are two types of loans. The CARES Act approved two different loan programs and changed the definition of a small business to include a business with 500 or fewer employees. The Economic Injury Disaster Loan and the Paycheck Protection Program are available to both small businesses and certain nonprofit organizations. The Economic Injury Disaster Loan is applied for directly through the SBA, whereas the Paycheck Protection Program loan is applied for through local banks. First, I will discuss the Economic Injury Disaster Loan. The maximum amount of the Economic Injury Disaster Loan is $2 million. An applicant may be advanced, however, $10,000 grant within 3 days of applying for the loan. The interest rate for nonprofits is 2.75%, and for businesses, 3.75%. The maximum term on the Economic Injury Disaster Loan is 30 years. Loan proceeds may be used for working capital needs and ordinary expenditures. Payments may be deferred up to 1 year from the origination of the loan. So how do you apply for the Economic Injury Disaster Loan? The application process is encouraged to be completed online. The applicant can expect a 14 to 20-day turnaround. However, as stated before, they may receive a $10,000 grant within 3 days of completing the application. Eligibility should be reviewed carefully, as this program is for any small business with less than 500 employees, including sole proprietorships, independent contractors, and self-employed persons, private nonprofit organizations, or 501c19 veterans organizations affected by COVID-19. Businesses in certain industries may have more than 500 employees if they meet the SBA size standards for those industries, which can be found on the SBA website by the NASCI code. The Economic Injury Disaster Loan is only available to borrowers that can show they are unable to meet their existing financial obligations as a result of the COVID-19 crisis. Cannabis businesses, casinos, and racetracks are among those that are not eligible. The most popular loan created by the CARES Act, which we are fielding numerous questions, is the Paycheck Protection Program. In most cases, the maximum amount of the loan is the lesser of 2.5 times monthly payroll costs, or $10 million. We will discuss average monthly payroll costs in a few slides. The current rate is 1%. All fees have been waived. Applicants must apply with a participating SBA lender. Payments are automatically deferred for the first 6 months. However, interest does accrue beginning with the funding of the loan. An applicant may request an additional 6-month deferment. The program ends on June 30th, 2020, or when the funding cap is reached. The PPP is first come, first funded. As we've seen in the news, they've already started talking about expanding this program by another $250 billion. However, we'll have to wait and see how that comes out of Congress. Next slide, please. So what is average monthly payroll cost? Average monthly payroll cost is calculated as follows. It is salaries, wages, commissions, and other similar compensation, plus cash tips, plus vacation, plus sick and medical leave, plus employer portion of health care benefits, plus the employer paid retirement benefits, plus SUTA, or other state and local taxes an employer must pay on employee compensation. From that number, you reduce it by compensation over $100,000 per individual. You also reduce it by compensation paid to an individual whose principal resident is outside the United States. You also reduce it by any payments made under the Families First Coronavirus Response Act. This will give you your payroll, which you need to get into a monthly payroll, and then you can multiply that by the 2.5 times, which would equal your loan amount. We're still waiting on guidance regarding how partners in a partnership will be treated. We check the Treasury website daily to see But does the partnership include the partner's income up to $100,000, or does each partner need to file their own PPP application? Because in most cases, partners in a general partnership running a trade or business will be treated as self-employed individuals. I believe we will get the answers to these questions in the near future. The PPP loan comes with a unique forgiveness feature. The amount spent by an applicant in the 8-week period, beginning with when the loan is funded, may be forgiven if the applicant maintains employee headcount and wages and does not spend more than 25% on non-payroll costs. For example, let's say the total loan is $500,000 and the applicant spends $400,000 within the 8-week period. If the applicant maintains headcount and wages and spends $300,000 on payroll and $100,000 on rent and utilities, then the applicant would submit documentation to their lender to have the entire $400,000 forgiven. If the headcount or wages decrease, the amount eligible for forgiveness decreases, as so if the amount spent for payroll drops below 75%. You have until June 30th, 2020 to restore your full-time equivalent employment and salary levels for any changes made between February 15th and April 26th. The amount forgiven will not be recognized as income and therefore be non-taxable. However, it'll be interesting to see if the intent of Congress was to make this a windfall, or if the double benefit rule will come into play, whereas the expenses paid by the amount forgiven would not be able to be taken as expenses when filing your taxes. We're on a wait and see there. Because you must verify and track your forgivable expenses, a best practice would be to set up a separate bank account to which loan proceeds can be deposited and from which qualifying expenses can be easily traced. At minimum, you should set up a new GL account. Next slide, please. The PPP is available from local banks that are SBA certified lenders. You can visit the SBA website to see which lenders qualify. The SBA affiliation standards apply, but waived for hotel and food service industries or listed franchises in the SBA directory. The PPP loan is guaranteed by the SBA and does not require personal guarantees from the owners of the business, nor does it require collateral. You cannot have the Paycheck Protection Loan and the Economic Injury Disaster Loan for the same purpose. However, a client may refinance an Economic Injury Disaster Loan through the Paycheck Protection Program. We're still awaiting the definition of same purpose. It's the same purpose COVID-19, or is it same purpose different than, like, if you're spending money on working capital needs and inventory versus payroll, or those two separate purposes? We're waiting some of that guidance from the SBA and the IRS. Another limitation of the PPP is that the employee retention credit, which will be discussed later, cannot be used if the applicant receives a PPP loan. When applying for the Paycheck Protection Program, an applicant must make several certifications, including that this current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant and the business. They must also attest that during the period beginning on February 15th, 2020 and ending on December 31st, 2020, the applicant has not and will not receive another loan under this program. The applicant must also certify that the information provided in the application and the information provided in all supporting documents and forms are true and accurate, subject to substantial fines and imprisonment. So those are basically the two loans. I'm going to ask Steve if, from a banker's point of view, What have you seen regarding the loans under the CARES Act?
Thanks a lot for letting me participate in this call. You know, the one thing I'd like to say to start off is we were very excited when the SBA and Congress decided to let the banks participate. There's no better way to get money out into the community, into small business hands than through the community and larger banks. I mean, banks touch all businesses. We have seen a flood of applications. We probably have 400 to 500 sitting in a queue. We have 200 that have been processed through the SBA system for a total of about 46 million to date. We started inputting on Friday, April 3rd. We've closed our first probably 10 loans. We have about 100 scheduled to close this week. We know that this past Friday was the date that you could open up to self-employed individuals. And we are still awaiting some guidance, but we're taking the applications and doing the best we can to verify income. So we expect another, new set of applicants to come through the doors, and we're ready to move forward with the guidance that we have in place, at least right now.
Appreciate it, Steve. Some other things that are going on in the CARES Act is that it provides for the automatic deferral of payments on prior disaster loans through 12/31/2020. And there's no need to contact the SBA. You just cease payment on those. Next slide, please. So how do you plan for the economic injury disaster loan? To begin the process of applying for the economic injury disaster loan, you should go to the SBA website, making sure you select the economic injury disaster loan option. You should have 1 to 3 years of tax returns, year-to-date financial statements, personal financial statements for all 20% or greater owners, general partner or managing members, and for any owner who has more than a 50% ownership in an affiliate business. You must also have a schedule of fixed liabilities and a completed form 4506-T or request of transcript of tax return for the business and others as described before, such as a 20% owner. Planning for the Paycheck Protection Loan, you should calculate your average monthly payroll either over the last 12 months or the 2019 calendar year. Most businesses will use the average monthly payroll for 2019, taking into account the excluded amounts mentioned previously. It's very easy to get this information together. It's all your payroll reports, your tax returns for payroll, 941s, 943s, your W-3. Those are the supporting documents you will need there. Once you gather your tax returns and financial statements for 3 years, you should also have your year-to-date financial statements and your articles of incorporation and organization. You should then contact your banker and gather any additional information, such as your driver's license, as soon as possible to get in line before the cap is reached. Remember, the PPP is first come, first funded. So in summary, the major differences of the economic injury disaster loan and the Paycheck Protection Program may be seen in this slide. Under the economic injury disaster loan, you can apply the employee retention credit, which is a refundable credit against your payroll taxes. Under the Paycheck Protection Program, you cannot. However, the loan, there is a forgiveness feature. The maximum amount under the injury disaster loan is $2 million. Under the Paycheck Protection Program, it's 2.5 times monthly payroll or $2 million. The interest rate under the injury disaster loan is 2.75% for nonprofits and 3.75% for businesses. Under the Paycheck Protection Program, it's 1%. And the payments can be deferred for up to 6 months under the Paycheck Protection Program and up to a year under the injury disaster loan. The term for the injury disaster loan is 30 years, and the Paycheck Protection Program is 2 years. So which SBA loan is right for you? We must be able to model each loan on a case-by-case basis and determine, among other things, if employee retention credits may be applied. In most cases, the Paycheck Protection Program will more than likely be the best route, but you don't know until you've asked the right questions and modeled the outcomes. There are many unknowns until we get more guidance. Our LaPorte CARES Task Force will continue to update our website and field questions as we continue to navigate our way through this crisis. Now we'll turn it over to Bruce Prendergast to lead us through the business tax provisions.
Muted. There we go. Okay, thank you. Thank you, Chav. I'm going to talk about the business payroll tax deferrals and credits. These were changes made to the tax laws, some of which were actually retroactive in order to provide liquidity to businesses as soon as possible. On our next slide, please. Your whole life, you've always heard pay your payroll tax deposits daily, weekly, monthly. You know, the law says it's got to happen right away. You've got to make those payroll tax deposits right away after you pay your employees their wages. This provision in the CARES Act allows employers to defer the payment of the employer portion only of payroll taxes due beginning on the date the bill is signed, which was March 27th, 2020, through December 31st, 2020. So for the employer portion of the payroll tax, you can defer writing that check, making that deposit from March 27th all the way through December 31st, 2020. The taxes are still due. 50% is due December 31st, 2021. 50% is due December 31st, 2022. So the liability is still there, but it's been put off a whole year, 2 years, 2.5 years into the future. Remember, it's the employer portion of the taxes only. And if you follow these guidelines and make the payments by those dates, there would be no late payment penalty. For self-employed individuals, it's the same thing, employer portion. So it's 50% of the self-employed taxes are granted the same deferral period. Now, for entities that receive an SBA loan, this deferral only applies if the loan is not forgiven. But the IRS came out just on Friday with additional guidance in this area and said that the deferral is not available only after you've been given the notice of forgiven by your bank. So you apply for an SBA loan today, you get your money next week. The 8-week covered period where you have to satisfy the test goes by. Another week or two goes by before your bank says, hey, the loan has been forgiven, you've met the requirements. During that entire period of time, you could continue to defer the payment of the employer portion of the payroll tax. Only when you've been given notice that your SBA loan has been forgiven do you have to start making current payroll taxes again, payroll tax deposits again. All of that stuff you deferred during that period of time is still due 50% December 31st, 2021, 50% December 31st, 2022. Can we go to our next slide? The employee retention credit. This is a refundable tax credit. So normally credits are limited to the amount of your tax. This one is one where it's a refundable credit. If the credit you're entitled to exceeds the amount of your tax liability, the IRS writes you a check. So this is a really good deal. Eligible employees are entitled to a credit of 50% of qualified wages paid to employees who are not working due to the employer's full or partial cessation of business or a significant decline in gross receipts. The credit is refundable. However, the qualified wages for each employee for all quarters cannot exceed $10,000. So for this one, you're counting the number of employees you have, you're looking at each employee as being eligible for up to $10,000 of qualifying wages times 50%. So each employee represents basically a $5,000 credit. Now, if you have more than 100 employees, the law says you can only take the credit on employees who did not work during that period of time. But if you have less than 100 employees, you can get this credit even if the employees were able to continuing to work. I would think the employer's full or partial cessation of business is what would be constituted by all the various stay-at-home orders we have. Qualifying wages are again March 12th, 2020 to December 31st, 2020, but it's $10,000 for all quarters put together for each eligible employee. The big one to know here is that the employers are not eligible for this credit if you receive a PPP loan from the SBA, and Chav mentioned that. So this is the sticking point a lot of people have. Am I better off with employee retention credit, or am I better off with a PPP loan that I think I can get forgiven? And there is no simple answer. You simply have to sit down and grind out the numbers and spend an hour or two on it and see which way is best. But either deal is a pretty good deal. This one goes on, they issued a form 7200 as part of the employee retention credit. The example on the form says, let's say you determine you're entitled to a credit of $10,000 on your employees for this particular quarter or for this particular pay period. So I'm entitled to a $10,000 credit. Now I'm supposed to deposit, let's say $8,000 of employment taxes. So normally I'd be writing a check out or making a deposit with a coupon for $8,000, but I can see I'm entitled to a $10,000 credit. So take that $8,000 and keep it. It's yours. It's your payment of your $10,000 credit. Then go fill out the form 7200 and ask for the other $2,000, and the IRS will send you a check. They imagine you will be filing multiple form 7200s if you decide to go this route, because as you determine you're entitled to a credit, more employees pass the test, you get further into this thing, you're still under a stay-at-home order, you're going to continue to keep the payroll deposits as your employee retention credit. You're going to continue to file 7200s to ask for the rest of the credit back. Now, if we could go on to our next slide. One more, please. Okay. The rule was always if you had a net operating loss from operating your business or a net operating loss on your personal return, basically a negative taxable income number, you could carry that loss back to prior year tax returns where you had income and you paid tax, and you could get that money refunded. The Tax Cuts and Jobs Act did away with that rule and said you can only carry losses forward. They've now reversed the Tax Cuts and Jobs Act, and they've reversed it retroactively. So we may have told you you had a 2018 NOL, sorry, there's nothing we can do with it. You got to carry it forward. Now, because of the CARES Act, you can carry it back. So taxpayers are allowed to carry back losses generated 18, 19, and 2020 to taxable years beginning before December 31st, 2017. You can carry it back up to 5 years. You can offset 100% of the income, not just the 80% limitation. So if you had a loss in 18 or you anticipate a loss in 19, you're able to carry those losses back now and get refunds. And I would imagine, depending on what happens with the economy, we may have a lot of people with losses in 2020. And next year at this time, we'll be filing a lot of carryback claims to try to get additional refunds at that point. But this is another big change in the law designed to provide liquidity and cash to businesses. Can we go to our next slide? This was also under the 2017 Tax Cuts and Jobs Act. If on your personal return you had flow-through business losses, let's say from K1 investments and partnerships and S-corps, you were capped at $250,000 of losses if single, $500,000 if married filing joint. So you may have had a lot of income from other sources, but your business loss was capped at to how much you could deduct. You couldn't generate an NOL. You may have still owed some taxes. They repealed this limitation retroactively back to January 1, 2018. So if you had losses limited in 2018, you should be looking at filing an amended return and getting an immediate refund. This cap has been removed for 18, 19, and 2020. So another part of the Trump tax bill that is being repealed, and it again is a very pro-taxpayer change. Next one, slide please. This was also part of the 2017 Tax Cuts and Jobs Act. It limited the amount of interest expense deductible for a business to 30% of the business's adjusted taxable income if your gross income was over 25 million or 26 million in 2020. Basically, they said if you're a very large entity with more than 25 million in gross receipts, we're going to limit the amount of business interest expense you're allowed to deduct. They've taken down 30% limitation and up to 50%. That's for 2019 and 2020. So if you're filing your 2019 return now, you want to make sure you're getting up to the full 50% deduction. There's some special rules for partnerships that say these provisions will only apply in 2020 for partnerships. And then they're kind of looking ahead, saying that we anticipate a lot of companies may have losses in 2020. So when they go to compute their interest expense limitation in 2020, rather than look at 50% of taxable income in 2020, we'll let them go back and look at 2019, which probably is going to be a higher income year. My next slide, qualified improvement property. This was a technical glitch that they corrected. Again, it's very pro-taxpayer. All leasehold improvement property is defined as qualified improvement property and eligible for bonus depreciation. So any improvement to the interior portion of a non-residential building that you're using in your business, the law said you had to depreciate that leasehold improvement property over 39 years. They changed it to 15-year life with the technical correction. But in changing it to a 15-year life, there's another provision of law that now says, take 100% bonus depreciation and fully deduct the cost of those improvements in 1 year. And again, this is retroactive back to 2018. So taxpayers who incurred expenses for qualified improvement property, you'd want to file an amended return for 18 and get that refund. So you're going to go on from depreciating an asset over 39 years to expensing it all in 1 year. Then if it generates an NOL, carry the NOL back and get those refunds. Another one is the minimum tax credits. This only applies to C Corps, but they did away with the AMT, and they provided in the 2017 Tax Act that the unused credit could be carried forward and you could use it in 2021. So basically they're saying they're removing the limit on how much of the minimum tax credit you get to use. They're accelerating the refunding of that credit against regular income tax. So this one you're only going to see if you're filing as a regular C corporation. The next slide is also for corporations again, C corporations. Normally a C corporation can deduct up to 10% of its taxable income in the form of a charitable contribution. So my taxable income is $100,000. I can deduct a $10,000 charitable contribution. If I go over that 10%, I have to carry that contribution forward and deduct it in the future. This year, they're saying, no, we're going to let C Corps deduct up to 25% of their taxable income, provided that the excess contributions are qualified contributions. A qualified contribution, the definition is cash or food to a charitable organization that is not a private foundation or a donor-advised fund. So C Corps can contribute and deduct more charitable contributions than in the past. The next slide really isn't on businesses, but it does give you some idea of the scope of how far this bill reaches into our economy. There's a provision in this law that says student loans. The repayment of federal student loans is suspended for 3 months. Interest is also not applicable for 3 months. And in fact, I think the final bill stretched this out to 6 months. So again, that's just how far-reaching this is. Another one that shows you how far-reaching they went with this stuff is the excise tax relief. You know, they're asking all these alcohol companies to convert to the production of hand sanitizing products. They're saying, don't bother learning the excise tax that would normally apply. We're just not going to charge it. So we can get people to move quickly into that area. And then my last slide is, what do I do now? Well, examine my depreciation schedule. Did I have any leasehold improvements placed in service after December 31st, 17? Let me make sure I get that properly categorized as qualified improvement property, eligible for 15-year life, then eligible for bonus depreciation. Look at tax returns filed for 18 and 19. Did I have an NOL that I thought I had to carry forward? And now I find out, no, I can carry it back and get immediate refunds. And then look at your interest expense. Is there any changes there that will help you perhaps file an amended return and get some refunds? That's all I have on the business provisions. I am turning it over to Mr. Connor for the individual provisions.
Thank you, Bruce. Good afternoon, everybody. The CARES Act isn't only helping businesses respond to COVID-19. There are provisions included specifically targeted at helping our individuals as well. The next 9 slides are geared towards shedding light on parts of this newly passed legislation. And this first slide is one of the most widely publicized of the provisions specifically targeted towards individuals, and those are the economic impact payments that are going to be sent directly to individuals from the Treasury Department. These economic impact payments are actually an advanced rebate of a specially created tax credit that will be calculated in full on the 2020 tax return. But let's not get too far into the weeds on that bit of nuance right now, as the 2020 filing season is still 8 months away and the 2019 filing season isn't even over yet. As you can see in the table on slide 33, these payments range from $1,200 to $2,400 depending on the filing status on the last return that an individual filed, with an additional $500 for each dependent child under 17 that was listed on that return. These payments are also subject to phase outs based upon adjusted gross income. The phase out is noted as $5 for every $100 of adjusted gross income in excess of the threshold amount. So as you can see in the table, for single taxpayers, the phase out begins at $75,000 and they are completely phased out at $99,000 of AGI. For heads of household, the range is $112,000 to $136,500. And for those that use married filing joint, the range starts at $150,000 and they are completely phased out of the credit at $198,000. An important point here is that in order to be eligible, an individual and any child under 17 must have a valid Social Security number in order for these payments to be dispersed. This rebate was envisioned as a way to get a bit of needed liquidity into the hands of individuals, and as such, these rebate payments are not subject to reduction or offset for previously owed taxes or other governmental debt collection orders. So if you owe the government money, they're not going to say, oh, congratulations, you got your advanced rebate, but we're going to go ahead and take that and put it against your debt. So you don't have to worry about that. Now let's talk a little bit about the preferred starting point on the calculation for these items. The preferred starting point would be your 2019 tax return. If that tax return hasn't been filed yet, then the calculation is based on the adjusted gross income from your 2018 return. If you haven't filed either a 2018 or 2019 tax return because you don't make enough money to file and you're not subject to filing because your only revenues are from Social Security benefits, or you just happen to fall underneath the thresholds, the calculation is going to be based on your 2019 Social Security benefit statement. Now, what that means in that last scenario that we talked about with somebody not having to file is that the Treasury Department won't have a record of any dependents that you may have, so your advanced rebate payment is going to more than likely be $1,200. As I said earlier, these advanced economic payments are an advanced rebate of a credit that will be calculated as part of your 2020 tax return. So if all you get is the $1,200 to start off with, then when you calculate the credit on your 2020 return, any amount over and above the $1,200 will be refunded to you. And it's not just those that are getting the $1,200. You know, technically, if you are phased out based on 2018 or 2019 adjusted gross income, and your 2020 AGI is lower in the range or completely below it, then what's going to happen is any additional credit over and above the credit that you got advanced, you're going to get refunded to you when you file your 2020 tax return. I can already hear the wheels kind of turning, which is people going, hey, wait, what if I'm entitled to less based on that 2020 calculation? We all know that what the government giveth, the government normally taketh away. But in this instance, it appears that any overpayments won't be subject to clawback to some others in the past. Now that we know how much the economic impact payment we should have coming our way, we can move to the next slide to help answer the question of how will the rebate be sent. The Treasury Department's preferred method to disperse these payments is via electronic funds disbursement. And they're going to disperse these funds to any account that the payee is authorized, either on their 2019 return or any account the payee authorized on or after January 1st, 2018. IRS has issued further guidance in this matter, as well as the timing of these disbursements, as we will see in a minute, because if no bank account is on record, a paper check will be sent to the individual's last known address. In addition, after 15 days after payment, regardless of the method, a letter will be sent to the last known address of the taxpayer with details relating to the payment, such as the amount, the date and method of the payment, and instructions on what to do if the payment was not received. Moving to our next slide, the IRS has issued guidance on the timing and methodology for disbursements. Per IR 2020-61 issued April 1st, 2020, the distribution of economic impact payments are to begin in the 3 weeks after April 1st, and they are planning to develop a web portal to allow those that don't have an account on file with the IRS to provide banking information so as to facilitate the electronic payment. Just this past Friday, on Good Friday, April 10th, 2020, the IRS went live with that web portal and announced that economic impact payments would begin being dispersed starting the week of April 13th, 2020, so this week. The portal can be found at irs.gov in their coronavirus relief sections, and or if you're going to type it into your search browser, it's going to be irs.gov/coronavirus/non-filers enter payment info here. Some other ways that the CARES Act targeted to allow individuals access to liquidity as a response to COVID-19 are going to be found on slides 36 to 38. So here we're going to move forward. As noted on slide 36, the legislation passed now allows individuals with qualified retirement plans, such as 401ks, IRAs, other qualified trusts, and certain deferred compensation plans, the ability to make withdrawals of up to $100,000 in aggregate from those plans for what are deemed to be coronavirus-related distributions in 2020. And so what exactly is a 2020 coronavirus-related distribution? It is any distribution to an individual who has been diagnosed with SARS/CoV-2 or COVID-19 by a CDC-approved test, or whose spouse or dependent has been diagnosed with it, or a disbursement made to an individual who experiences financial hardship due to quarantine, business closure, layoff, furlough, reduced hours, or being unable to work due to lack of childcare due to COVID-19. As you can see, the definitions of who is eligible to take one of these distributions is very broad. In addition, the Act goes on to clarify for plan administrators that they can rely on the declaration of the plan participant that the distribution is indeed a coronavirus-related distribution and go ahead and make it. These distributions are only allowed before January 1st, 2021, and distributions under this provision also satisfy the hardship distribution provisions of the code and will be treated as exempt from withholding. The tax treatment of coronavirus-related distributions depends on whether an individual recontributes the distributions or takes it into income. If the decision is made to take the distribution into income, thereby making it subject to income tax, The taxpayer can elect to include it ratably over 3 years in their taxes beginning in the year of distribution. So they would take in equal installments in 2020, 2021, and 22. They would include that distribution in their tax return and pay taxes on it. Or if a taxpayer within 3 years from the date of the coronavirus-related distribution was received decides to contribute the funds in one or more contributions not to exceed the original amount, they will be considered to have been transferred as if from a trustee to trustee within 60 days of the transfer, as according to the rules as noted in the code. As noted at the bottom of the slide, the recontribution does not affect the retirement account contribution caps. And speaking of distributions, as we move to slide 37, we can see that the CARES Act waived required minimum distributions for 2020 for defined contribution plans, 401ks, some for deferred contribution plans deferred contribution plans maintained by eligible employers, and IRAs. This applies for all distributions that may have otherwise been required to be made in 2020. This is being done in the hopes that these accounts will have time to rebound from any losses experienced due to the pandemic, and because if required minimum distributions were made, the steep decline seen in 2020 would mean that a retiree may have had to use a larger percentage of their account to fund the distribution. If you already received an RMD prior to the CARES Act passing, and it is within the 60-day rollover window mentioned previously, you can recontribute the distribution and have it treated as a qualified rollover and not included in taxable income during 2020. If you are now outside the 60-day window, then it isn't eligible for rollover treatment, but there could be a workaround available to you. That discussion is too nuanced and changes depending on fact patterns too much to continue here, but you should contact your LaPorte advisor immediately to make them aware of the situation and to see if an alternative is available to you. Distributions aren't the only means of liquidity available to you from a qualified retirement plan. Slide 38 shows us how the CARES Act made some changes to the loan limits and repayment schedule of those loans with regard to loans that are made within 180 days of the passing of the CARES Act. That last statement was an important one, as you only have until September 23rd, 2020 to take a loan and have the rules I'm about to go into apply. For loans made during the eligible period, the loan limit is raised to the lesser of $100,000 or the present value of the non-forfeitable accrued benefit of the employee under the plan from the lesser of $50,000 or 1/2 of the non-forfeitable accrued benefit. So they've basically picked you up from $50,000 to $100,000. In addition, the rules have been changed for anyone that has a qualified loan outstanding and a repayment due from the date of enactment of the CARES Act, which was March 27th, 2020 through December 31st, 2020, and it allows them to delay loan payments for up to 1 year. Interest will still accrue during this period, but since you are paying yourself back, this really isn't the end of the world. Let's move forward to slide 39 and talk about the changes to the charitable contribution limits that were changed by the enactment of the CARES Act. Bruce previously mentioned some that were applicable to businesses. These are going to be applicable to individuals. For those that are itemizing deductions, the 60% of AGI limit that was imposed by the Tax Cut and Jobs Act is suspended for 2020 cash contributions made to qualifying organizations. Any excess contributions may be carried forward to future years based on the current rules for excess charitable contributions. For those that are not itemizing, the Act allows for an above-the-line deduction for contributions up to $300 made in cash to a qualified charity. Unlike previous disaster gift limit changes, there is no stipulation that the contribution be made to a disaster recovery charity. It only stipulates that the donations have to be made in cash to a public charity or foundation as described in Code Section 170B1A in 2020, and that contributions made to private foundations, supporting organizations, and to donor-advised funds do not qualify for the charitable contribution limit changes. Finally, as we move to slide 40 and begin to wrap up my portion of today's formal presentation, the CARES Act allows individuals to exclude up to $5,250 of loan payments made by an employer for an employee's education loan to be excluded from income in 2020. There is some intricacy involved with what I just said and is really easy to miss. So let me point out that the loans that are being paid on by your employer must be the employee's and not a loan incurred for the education of the employee's child. In addition, this exclusion only applies to payments made by an employer after March 27th, 2020 and before January 1st, 2021. One last thing to remember regarding these payments is that the Internal Revenue Code and the CARES Act do not intend for any individual to receive double benefit from the same part of the legislation. And what that means is that if an employer makes a payment on behalf of an employee on their qualified loan, the Act disallows the employee deduction for interest paid on that student loan for 2020. As we move into my last slide, don't forget that LaPorte is here to support our clients as they make decisions on how to proceed in the wake of the CARES Act and any other legislation that may grow out of this pandemic. Slide 41 denotes some of the ways that we are here to help, so please don't hesitate to call us so that we can help you review qualified retirement plan account balances and projected cash needs to decide if a coronavirus-related distribution is advisable, or to help you decide if a loan from your qualified retirement plan makes more sense than a coronavirus-related distribution, or decide if we can forgo RMDs for 2020 to allow your qualified retirement plans to rebound, or to do some calculations to see if taking advantage of the charitable contribution limit easement is a viable tax strategy for 2020 if you itemize. If you aren't itemizing in 2020, we can go ahead and give you guidance on charitable contributions for the above the line deduction that I mentioned previously. And with that, thank you for your time. And I would like to turn over the reins to Micah Stewart so he can take us through the Q&A portion of the webinar.
All right, thank you, Connor. We've got a few questions lined up right now. The first one is probably going to be for Chav. The question is related to the PPP loan. It says, is the reduction of the forgivable portion of the PPP based on employee headcount or payroll costs?
Yeah, Mike, that would be based on both. It's on the employee headcount and payroll costs. For example, if I have my employee headcount is 100 and it reduces to 70, it'd be a 30% reduction in the forgiveness portion. Okay, so you look at it that way, and you look at it from a wage standpoint per person. So you have to go through each individual that you still have hired in your company. And let's say that you had somebody that was making 70,000 and you drop them down to 50,000. That would be more than a 25% reduction in their wages. So you would also have to take that into consideration of when you go to look at the forgiveness portion. Now, if you have somebody over 100,000 and you drop them, you won't have to look at them. And if you drop somebody less than 25%, so let's say you drop somebody from 80,000 to 72,000, that's only a 10% reduction. You wouldn't count them as a reduction in your forgiveness portion of your loan.
Okay. And then this is for Connor. Does a child under the age of 17 receive the tax credit regardless of his or her parents' income?
Unfortunately, no, because just as minors are not allowed to contract, when they're under the age of 18, any of these children that are under the age of 17 and claimed by their parents, their phase out goes in line with their parents. There's not a separate phase out amount, and they would not receive the $500 regardless.
Okay. And this one I cleared up with our marketing folks. It says, can we receive the slides after this, please? From our marketing group, we will be sending out the deck, and a copy of the recording within 48 hours of the presentation. So that's that. Next question. This looks like for Bruce, for the employee retention credit, when do we have to file the Form 7200, and where is the form available?
Well, the Form 7200 is available at the IRS website, irs.gov, just like all IRS forms and IRS instructions. So go to irs.gov. There's a click on the button to pull up IRS forms and instructions. I think the answer is you're going to file a Form 7200 multiple times. Every time you think, hey, I'm entitled to a credit, and it's an advance, and it's more than I'm going to get from withholding the payroll deposit, you should file the form. I'm pretty sure the form anticipates you'll file it multiple times. So as you see you're eligible for the credit, you're going to file the form.
Okay. Chav, this looks like it's for you. What if you don't drop the employee's rate, but you drop the hours? Therefore, they're getting paid less because they are not being paid overtime. Does this count as a reduction in pay?
What you do is you go back and look at the same time period that you paid them over last year and compare it to that time period. And that's what you do that on a per individual basis and compare what you paid that individual compared to what you paid them last year.
All right, and then the follow-up to that is, what time period is the original headcount based on to determine your headcount reduction?
It's based on the time, if I'm understanding the question correctly, you look at the time period that you had last year versus the time period that you had this year. The headcount, let's see, it goes from, you have to have everybody reinstated by June 30th as full-time equivalents. And that's for the headcount of the number of employees between February 15th through April 26th, 2020. As long as you can get them back up, the headcount back up by June 30th, you'll be okay. But the problem there is you may have a problem getting the wages up to the over the 75%.
Okay. And then here, this one's for you again, Chav. It's a PPP related question. If my 2019 headcount was higher in 2019 than pre-COVID 2020 headcount, but we used the 2019 940, how do we calculate accurate forgivable headcount? My headcount was higher in 2019 than pre-COVID 2020 headcount, but we used the 2019 940. How do we calculate accurate forgivable headcount?
Again, you go back to that 2019 period to see what your headcount was. If it reduces from that, then you're going to have a reduction in your headcount.
Okay. This is for Bruce, for the employee retention tax credit. If you have 10 employees in the first qualifying quarter and all 10 have wages exceeding $10,000, confirm that each employee is maxed out for the remainder of the program. If you hire new employees in another qualifying quarter before year end, confirm that you can bring them into the calculation during that quarter.
It's $10,000 per employee. So if once you hit the $10,000 amount for that employee cannot generate any additional credits for you. If you hire additional employees, then I haven't seen anything that says the answer is no. So I would think the answer is yes, that those employees would also qualify for the credit. But I have not seen that specific question or answer anywhere in anything I've read yet.
And then this one goes back to Chav. This came in through email. Do 501c3 nonprofits and or local county parish-owned hospitals qualify for the PPP loan?
Bruce, I believe you're unmuted as well. As I know you've got some nonprofit there, but the 501c3s would.
The PPP loans qualify for the 501c3s qualify for the PPP loans. I'm not quite as sure as which types of nonprofits qualify for the normal economic disaster loan, although I think that is a more broad definition of nonprofits that will qualify. the issue you get into with things like hospital districts and stuff like that, is that a governmental entity or is that a nonprofit? And I honestly do not know the answer to that question, but I could not tell you the answer to that question of the normal tax law, because certain entities like that are both nonprofits and governmental entities. So I don't know exactly where they would draw that distinction.
Okay, and this goes back to Bruce again. If for March we paid the employees fully and paid the taxes complete, can we still file Form 7200 later?
If you had already paid the wages for March, you know, have you already filed your 941? If you haven't yet filed your 941 for that first quarter, I think you'd claim the credit on the 941. But if you've already filed the 941, then I think you'd be looking to file the 7200.
Right.
All right, here's another question. This looks like it's for Chav. Would the double benefit bar affect an individual who was a 1099 contractor to a business in which he had no ownership and a single member LLC owner in another completely different business? Not sure.
It seems like that question is saying that the individual is a self-employed individual
Right.
and had no ownership and a single member LLC. So he's a single member LLC, and he's doing work for other people, or she is doing work for other people, and receives a 1099 from them that they would include their single member. More than likely, as a disregard entity, they would be filing a Schedule C. The PPP loan there would be, you would go and provide the Schedule C as your documentation in the loan process as your net self-employment earnings. From a double benefit rule, I mean, we haven't seen much guidance come out on the forgiveness yet, but from a double benefit rule, I don't believe that would apply, because you're basically getting the loan for your net self-employment earnings. So it wouldn't be an expense to yourself. It'd just be the loan to take you forward in your business.
Right.
So it's the self-employed earnings. So if that's the case, then, and, you know, I'm speculating here with the Congress, but I would think that their intent was to make everybody put money back into the economy, and if they took that away, then it's not really forgiveness of the loan for a self-employed individual.
Right. Okay. Again, for Chav, the PPP forgiveness criteria doesn't seem to look at business revenues or true need for cash in these uncertain times. Do you think they will look at the need of individual companies, i.e. looking for true decline in revenue or cash flow constraints before forgiving?
Again, you know, the audit, when the governmental entities get involved, and the congressmen and legislators step away from the podium, and the government agencies get involved, we always have some, you know, they can come back and do an audit. Whereas, do you think they would look at the actual need of individual companies? I don't think that was the intent of the CARES Act. I think the CARES Act was meant to stimulate the economy and get cash back into it as quickly as possible. And the easiest way to do that was to basically do what they said, was to protect everyone's paycheck.
Right.
So that you're not going without income or
Right.
cash. So that cash will be readily available to restart the economy.
I think the test is pretty straightforward, right, Chav? I mean, if you meet that 75% of wages and then you use the other 25% on, you know, mortgage interest or utilities, you know, that's the test for forgiveness. They're not looking at your revenue or anything like that.
Not yet, and I don't think they will. I think it would be since you have both parties basically passed the CARES Act, then especially being a political year, I don't think they'd go back and do that. I'm just, like I said, I'm speculating. The double benefit rule is in the code, though, however, and unless they give us some guidance, it's going to be interesting to see how that plays out.
Okay.
Chav, and Micah, if I may, the The only other thing the PPP program says is you're supposed to initial offer certify that you have economic uncertainty about your ability to meet ongoing operations given the coronavirus. You know, and it's just this question of, do you have economic uncertainty? Well, you know, is this thing going to end next week, next month? Is this going to go on through Thanksgiving? Well, does anybody really know? Is there going to be round two if we reopen businesses too soon? I don't know. But those are all the types of things you hear. And as a business person, as someone who's trying to be prudent, all those things give me a lot of economic uncertainty about how long this thing is going to go on for.
Okay. Yeah. So this one might be for Chav and Steve. This is a follow-up to our earlier question. It says, please let me clarify. We had 18 employees in 2019. At the end of 19 and in early 20, 4 left to pursue other interests, i.e. jobs. We were advised by JP Morgan to use 2019 940 headcount on our new current headcount is 14. How do we remember this correctly as headcount going into COVID phase? Just last week, one guy had to leave to a treatment center, but he was in the PPP headcount. Do we need to hire ASAP to fill these gaps?
For a headcount, I think you got to maintain the average number of full-time employees from 2/15/2020 to June 30th, 20. June 30th, 20 as compared to the 2/15/19 through the 6/30/19 or the period between 1/1/20 and 2/29/20.
So I guess the question is though, Chad, do you have to rehire people or can you hire, and I don't think there's an answer to this, but your thoughts or maybe everybody's thoughts on, do you have to rehire that same person or can you hire somebody else to fill that gap? Because it says employee, it says
the
employee.
position full-time equivalent employee, which is defined at the SBA website as being, you know, an individual with 30 or greater hours. If somebody works, if you have part-time employees under 30 hours, you can take those part-time employees and add them together. So like if I had somebody working 2 people working 20 hours, I have full-time equivalent employee there. If I had 3 working 20 hours, I'd have 2 full-time employees.
Okay.
I believe what they're asking though is if they have an employee count before before 2/15/20 of of a certain amount, which is less than the amount they had in the first quarter of 2019, what would they do to compare their full-time equivalent employees? And I think you can look at the 1/1/20 through 2/29 period to see what your employee count was.
Okay. Another one. In 2019, we had a total employee headcount of 24, including part-timers and interns, not FTEs. Immediate pre-COVID, our count was 15. For the PPP forgivable reduction calculation, are we held against the 24 count and not the 15? If the former, can we make a couple of very short-term hires before 6/30/20 to get our head count up during the comparable period and reduce or eliminate the reduction amount?
I think it goes back to the definition of full-time equivalent
Right.
From the SBA, and you start looking at that, and then you can, just like I went into the part-time, I believe the interns probably be included in that same boat. If they're working less than 30 hours, you would take all their hours, add them together, and that would be your full-time equivalents.
Okay, next question. If you are filing payroll taxes every month, do you have to file the 7,200 every month or every quarter?
No, as I understand it, you only file the 7,200 if you're seeking an advance refund of the credit amount, or you're trying to get more back than what you paid in. If your eligible credit is less than the payroll tax deposit, then you would just retain the payroll tax deposit as your payment on the credit, and you wouldn't have to file the 7,200. The advantage of the 7,200 is I don't have to wait till the end of the quarter to file a 941. So I can file it as I'm going and get an advance payment. But if the credit is not more than the payroll tax liability, then I wouldn't think you'd have to file a 7,200.
Okay. This is for either Chav or Steve. It looks like. Please repeat the dates on the qualified periods for the head count, so I might write them down.
Yeah, it'll be in the slides, the slide there that you received, but to maintain the average number of full-time equivalents for the head count, is from 2/15/20 to 6/30/20 as compared to the 2/15/19 to 6/30/19 period, or 1/1/20 through 2/29/20.
And that's all the questions that we have so far.
Okay. We don't have any more questions, and if you don't feel like yours was addressed properly.
Oh wait,
Please
hold on
reach
a
out
second.
to one
One
of
second,
us.
Chav. One question,
Okay.
real quick. In 2019, there was a bonus given to some employees. Will that be included in wages for the PPP?
Yes. Any cash payments made to the employees will be included in that, in the calculation.
That's it.
So. Yeah, we'll give it another 15, 20 seconds, see if anybody else has another question. But while we're wrapping up, we certainly appreciate everyone joining us today. We will email you a copy of the slides we used today. If you have any questions that were not able to be addressed today, please contact one of us via email, and we will call you to follow up. Or you can visit our LaPorte's Coronavirus Resource Center. The slide that's on the that you're seeing right now has everybody's email. Like I said, we have your email, so we will be emailing you a copy of the slides. And if you have any other questions, please feel free to contact us. We strive to help the community and our clients. So please reach out if you have any questions. We appreciate you attending today. Thanks.